Right, good morning everyone. I think we can, we've still got a few people joining, so I'll wait. Okay, I think we can begin now. First of all, thank you very much for joining us this morning for a somewhat timely update given what's been happening in markets over the last few days. For those who read the headlines, the FTSE 100 has hit a low point of 6 months, but the FTSE 100 is certainly not the stock market as a whole. And as I found in a recent clip, Tony Benn complained in 1976 that the FTSE 30 at that point didn't reflect the economy. The stock market as a whole this year has been not reflecting the economy as a whole. The S&P 500 in the US is up 6%, and we've got the Chinese market up about over 30%, and Asian markets all positive. The FTSE is a very unrepresentative index of what's going on in the world of equities. So beware of looking at that. As I speak to you, we're being hit by I think it was a holy trinity of headlines that are unhelpful and difficult for us to keep up to speed with, frankly. We've got the pandemic, which we're seeing tighter and tighter controls. We've seen expect further lockdown in France, that to be announced this evening, and Germany, and in the UK it's gradually spreading across the country. We've got the US election next week, which is causing all sorts of problems in terms of getting a stimulus package through there. And finally, and probably the least important as it turns out, but perhaps for the people of the UK, perhaps more important, we've got Brexit, where at the moment there's very little news coming out in the last few days, which may be hopeful that there is some kind of deal being worked out behind the scenes. They're certainly talking, so it continues. This morning I'm going to look at all three of those factors, but I'll also be looking at the fact, the way that we think things will go after these things have passed. The pandemic will eventually, we'll see a vaccine, or we'll see we'll reach herd immunity, and it will fade into distant memory in the years to come. The US election may turn out to be less of an event than we thought, and Brexit will be sorted one way or another, and we will be living with the consequences of that in the years to come. Firstly, we have to address the ongoing COVID-19 pandemic. With over 1 million people dead, we have to remember that each of those is an individual tragedy. Many more people will have illnesses that carry on for a long period. And perhaps there is an even worse thing that's happening, is that people are getting undiagnosed for serious illnesses, as they don't go to hospital, don't go and see doctors, and don't get tested. So we have to think of those people, but equally as investors, we have to be dispassionate at times and look at the market impacts. And I apologize if this is offensive, but we have to stand back and just be dispassionate, as I say, and look at the economic impact. The economic impact has been bigger than anything I have experienced in my lifetime. Globally, it cannot be ignored. Perhaps the only country that hasn't actually been impacted by it in one way or another is Vietnam, where they seem to have some kind of genetic resistance to it. But China was hit by it, but has been dealing with it much better perhaps than other places in the world. In the UK, we've seen GDP decline over 20% in the second quarter, and in the US it was down about somewhere between 8 and 10%. We're going to see the third quarter bounce back, but then with these further restrictions coming in the fourth quarter, we're going to see the economy go down again. Maybe this latest round will not be as harsh as the second quarter slowdown. It depends on how tight these restrictions get, and where they go from here. We can't predict the short-term consequences of this, but while we have seen these tighter restrictions, there does seem to be progress on, I think, 12 vaccines now in the third stage of testing, and so hopefully there will be something that comes through in the months to come. There's talk of something being first released in December. The Russians are already vaccinating something, but I take that with a pinch of salt, should we say. As far as markets are concerned, it's been a case of dispersion of returns. We've got the UK market, I think this morning when I looked at it, was down 26% on the year in the FTSE 100. But in the US, the market's up 6%. As I said earlier, the Chinese Shenzhen index is up 36%. The Korean market's up 10%. Taiwan up 13%. European markets are all down across the board. Curiously, this is partly due to the composition of the index. The S&P 500 has a high concentration of technology. The NASDAQ index, which is more weighted towards technology, is up 29% this year. So your returns from portfolios do not necessarily reflect the FTSE 100 index at all, if you've got a diversification. Also within markets, the dispersion between sectors, I've noticed the technology sector outperforming, and within stocks, within sectors has been extremely high. Even with technology, which has done well, we saw last week results from SAP in Europe, the software company, which is down 18% year to date. Microsoft up 36% year to date, both basically software companies, but in different areas. So this is an opportunity for selective stock pickers that has frankly rarely been better. And some of our active managers have been quite strong outperformers this year. The countermeasures to the pandemic are actually doing more damage than the pandemic itself economically. But the measures taken by central banks and governments have been quite extraordinary in terms of their size and scope. Interest rates and bond buying has been extended to corporates. The Federal Reserve has even changed the way it targets inflation, which will be important. We'll look at that a little bit more later, and the way they target unemployment, which will allow for an average of interest rates, average inflation over time. So their target of 2% inflation, if it's been below 2% for most of the last 10 years, it may be above 2% for quite a long period of time before that average is hit, which means that they can keep interest rates and stimulus in place perhaps much longer, even if there is some signs of inflation, which I think may be difficult. Governments have mostly taken their part, boosting spending and supporting unemployment. It was interesting, the furlough scheme in the UK was introduced before they introduced movement restrictions and shut down the economy back in March. That prevented unemployment rising much more steeply in the UK, but as that comes off and is replaced by less generous schemes, we may see unemployment rise in the UK. In the US, where it came in later, there was a much steeper rise in unemployment. However, the politicians, as ever, have played their part. And as we get towards the US election, the Republicans and Democrats have been disagreeing over their latest round of stimulus, and perhaps the latest sell-off is at least in part due to their disagreement and failure to pass the latest stimulus package. The Democrats want a 2.2 trillion package. The Republicans want less. Mitch McConnell wants a lot less, the leader of the Republicans in the Senate. So we want to watch this space, but they will eventually pass a package. It's just a matter of time. The EU has come up with a 750 billion plan for recovery from the pandemic, but at the latest summit, they were still arguing over the details, and the implementation of that may now be delayed as a result. Markets have frankly often felt like a balancing act between the economic downturn and the stimulus, and that will continue. So when we get the ECB meeting tomorrow, we may get more hints of more action, and probably more action in December from them. But there'll be the Federal Reserve, for instance, has been crying out for more fiscal action from the government, but that will now certainly have to wait until after next week's election, or that later. As I say, when you look at the detail of the performance, it's down to individual companies. Those with good growth prospects that can survive this and good, strong balance sheets have done well. Others are going out of business. Even within, there's been an acceleration perhaps of some of the trends that we've seen in place, particularly in regard to online shopping and the death of the high street. This is unlikely to reverse. It can be seen in the stock market with Amazon up 77% this year and Marks and Spencer's down 56%. Just shows where people are shopping at the moment. We were already in this country moving more and more online, and the high street was dying. It's going to be, that's unlikely to reverse anytime soon. Work from home has certainly shifted the way people think about things. And interestingly, my wife was sort of surfing the property market locally, and properties in the country with gardens and things like that are nearly all under offer. And yet I'm hearing that people in London are finding it difficult to sell townhouses because people have realized that they can work from home. And I think that may be a trend that continues. That certainly helps some of those sales of monitors and things like that. Asia has come through this much better than in some cases, or in some cases at least, not perhaps in India, but much better. And they've been much more disciplined in the way they implemented the restrictions. In China, where it all started, they report hardly any cases. Now, there may be some question about that, but there was one case in a Chinese city, and they promptly tested 5 million people. They've got a scale of operations that is much greater. They shut down much more tightly when they shut down, and people accept it. I don't think in the West that we accept the discipline of the lockdowns that have taken place in China and elsewhere in the Far East. Yeah, the UK government response looked timely and strong initially. Perhaps there are some questions now with the school meals and the track and trace failures that are beginning to show splits even within the government. So there are going to be further measures and gradually shifting from the different tiers in the UK, gradually getting tighter. But the UK economy is not the UK stock market, and the UK stock market is not the equity market as a whole. And I want to make that absolutely clear. The UK stock market, the FTSE 100, derives somewhere between 70 and 80% of its earnings from overseas operations. But the index itself is composed very heavily of oils, banks and financials, and has virtually, I think it's less than 2% in technology, whereas the US index is more like 25 to 28% technology at the moment. So there's a big difference there. What is becoming clear, I think, is that the pandemic has hit those who are mostly in the service sector and low wage economies harder, and perhaps the young people who work in those sort of areas harder than those like ourselves who are in a beneficial position, who can work from home relatively easily in the white collar jobs. And those that the boost to the stock market internationally has benefited the rich, particularly in the US perhaps, at the expense of the poor. This is driving political decisions and extremism, and makes for very bitter divisions within countries. On that note, perhaps is a good point to talk about the US election. Trump may yet win, but Biden is well ahead in the national polls, but the national polls are a very poor guide really to what may happen in the Electoral College, which is made up of delegates from individual states. Hillary Clinton in the end won the popular vote by, I think it was a couple of percent, but lost the Electoral College. It looks like Democrats this time will certainly win the popular vote. They are ahead in most of the key states that will make up the Electoral College, but watch Florida in particular on that front. The Democrats could also gain control of the Senate. For those who want to see sort of the detailed breakdown state by state, I'd recommend Nate Silver's website, 538, that's 538 in letters, which gives a breakdown state by state. The Senate race, which will be key if Biden gets in, because he may have difficulty getting appointments through if the Republicans hold on to it, is interesting. The Senate at the moment is 53 Republicans with 45 Democrats and 2 independents. The independents generally vote for the Democrats. So they need to gain just 3 seats if Biden wins. The vice president has the casting vote in the Senate, so they'd be 50-50 with the vice president as the casting vote. There are 35 seats up for election. 23 of them are held by Republicans and 12 by Democrats. So there's a good chance. I think the key states to watch here when as the results come through will be North Carolina and Georgia, Colorado, possibly even Texas and Arizona, which was John McCain's old seat. John McCain being a Republican, but having been decried by Trump so viciously, then that may even Arizona, which would normally be Republican, may swing. Perhaps the emphasis on this was drawn by the demise of John McCain's mother, who died aged 108 earlier this month. It is very unlikely that we will get a concession on the night. Trump loses, he will contest the postal votes that generally favor the Democrats. Nearly 50% of the people who voted last time have already voted, and a large number of those will be postal votes. And the postal votes generally favor the Democrats. The last time we had a contested election, and Mr. Trump has said he will not contest the election if he wins. I think that the last time we had a contested election was 2000, when Al Gore ultimately lost out to George W. Bush. For those of you who remember that, it came down to, I think it was a margin of 530 votes in Florida at the final count, with hanging chads. That's the little bits of slips of paper because they worked on punched cards in the voting machines, and some of the punches weren't completely through, and they were being examined with microscopes and things to see how they'd gone, and that ended up with the Supreme Court. The result was not out until the 26th of November. During that time, the S&P 500 fell about 10%, but it was in the middle of the post-tech bubble, post the 2000 bubble, and it may have fallen that much anyway. This time, a presidential, the dispute is kind of almost expected if it is close, whereas it perhaps wasn't expected then, it was something new. But Florida will yet again be key in terms of the presidential election. If, as I said earlier, Biden fails to win the Senate, then making some of his economic changes and things that he would like to make may be more difficult, and getting his appointments through. And there's something like 1,200 appointments that are presidential appointments that get confirmed. But key will be his Treasury Secretary and the economic posts, which may get blocked in the Senate. But assuming that we get what's called as a blue wave, which is the Democrats winning both the presidency and the Senate, then there will be some policy changes. I think that the stimulus package will be larger, but equally then the restrictions to counter the pandemic may be stricter and more widely enforced. So you've got something positive and negative. There'll be higher corporate tax rates. They'll be reversing some of the tax cuts that Trump put in place, which will weigh on the market. But there'll be more investment on the environment, which would not be great for the oil and coal. Those looking for a value rally may be worried, but may like to think about that. I think he'll continue to be tough on China and Russia, but more measured, and will work with the EU, Mexico and Canada and other countries, and maybe less confrontational in terms of Asia and China in particular. So that will generally be positive on global trade and perhaps good for the market. The one thing that I will welcome above all else, and perhaps will make my life a little bit easier, will be an end to the policy by tweet. We've come in the last few years used to not looking, when the market moves, not looking for economic indicators, but looking for what Trump said on a tweet. That will end, and that'll be a very welcome thing. However, we have to consider whether Trump might win the election if he continues as president. Then we'll have more of the same. We'll still have an aggressive attitude to China. We will have We will still get a stimulus. It might not be quite as big as it would have been under the Democrats, but we'll still get the stimulus to come through, and we will have perhaps a business-friendly president in place. On balance, I don't see either result as hugely negative. Progress on COVID and a vaccine will be much more important. But if there is a disputed election, then that just adds uncertainty in the short term and may increase the volatility even further than we've seen in the last week. And that's perhaps what is being reflected in markets today. Final thought is that Biden is not a fan of Brexit and is very much supportive of the Irish and open borders with Ireland, and wouldn't be against anything that imperils the Good Friday Agreement, which some of the latest legislation in the UK has particularly hit out at. Brexit, which brings us on to the dreaded Brexit. I have to put my hand up here and say that I voted against it, but I accept that the country voted for Brexit, and we are going to deal. There's no point in trying to go back on it. They need to deal, and a trade deal will be a good thing. It appears that we are now moving towards some kind of concession. The fact that we've had no news this week is probably good because they are talking. Barnier has been here talking to our negotiators. But the level playing field on regulation, the final jurisdiction, there's a very firm sticking point. We don't want the European Court of Justice involved. And finally, the dreaded fishing question, which will be a sticking point for France. In France, there are about 10,000 people employed in the fishing industry, out of a workforce of 28 million. In the UK, it's a little bit more than that actually, and out of a workforce of about 36 million. So we're talking about, I think it's 0.03%. It's a tiny proportion of the of employment, but the political significance on both sides of the channel is huge. And Macron faces re-election in 2021, and that may yet be a sticking point that cannot be overcome. I suspect in the end that we'll get some kind of partial deal, and ratification will then have to proceed through European parliaments, although that's never a given that it will pass smoothly, and a delay may eventually come about, if only just to complete the ratification process. When the EU did a deal with Canada, the Belgian region of Wallonia was able to hold up the deal and get things amended to suit them. So, it's not even at national government level that you can get a hold up. It could be something in the regions that blocks it in some way or another. If there is some kind of comprehensive deal, it would broadly be positive for the pound. This would probably weigh heavily on international companies in the FTSE 100, but international investors have been shunning the UK market because of the uncertainty around Brexit, and may return to it at some point, which would mean that you could probably buy the dip rather than anything else. The UK on the surface looks cheap relative to other markets. It has a low PE. Even after the dividend cuts that have taken place this year, the dividend yield is higher than other developed markets. But that perhaps reflects the composition of the index rather than necessarily it's, if you reweighted other indexes to that you might find the same picture. It's estimated that a no-deal Brexit could slow growth in the first year by 1 or 2%, but that's way less than the impact of the pandemic. And for the government, it may be a good time to bury bad news. The effect of COVID is way greater than Brexit, and Brexit is almost becoming a side issue for markets as a whole. In the long run, there's a question now about how we pay for the coronavirus. National debt burden in many countries has risen through the crisis and will have to be paid eventually. Broadly, there are three ways to do this. You can tax to raise money. You can create inflation that would diminish the real value of your debt, or you can grow your way out of it by growing your tax revenues. Raising taxes to pay for a disaster can have very, very bad consequences. In the 1930s, that happened after the Great Depression. And that basically, that caused the Great Depression, really, in terms of one of the causes, contributory causes anyway. Rishi Sunak should think twice before raising taxes too much, but there appears to be some talk about taxes, and you've got to be very careful how you do that, where you direct it. Inflation was stubbornly low before the pandemic. It's been stubbornly low in countries such as Japan, in Europe, where there were already huge stimuluses in place and post the financial crisis. And it's very difficult to generate at the moment. Unemployment, high unemployment, which will persist for a time after the pandemic as the economy gradually recovers, so will unemployment, but it will be there, will add to the deflationary pressures. The technology, the internet is deflationary in the fact that it makes price comparisons easy. Automation is, and robotics, I mean, you need less people to produce stuff, and you can reduce your costs there. And aging populations in many parts of the world have also been anti-inflation, at least. So despite the amount of money that has been pumped into the economy, the chances of inflation running really hot are relatively low, and it'd be quite difficult to inflate your way out of your debt problem. The Federal Reserve has indicated that it will look at an average of inflation at 2%, so it could allow inflation if it managed to generate it, and I doubt that somehow. Then interest rates could remain low for a very long period of time, even if inflation went above 2%. But that we're not talking about it returning to the levels we saw in the 1970s. Economic growth and getting rising tax revenues through growth is the best way out of it. However, with aging populations in some countries, I'm thinking of Italy here, perhaps in particular, Germany and Japan to a lesser extent, because they've got manufacturing economies, significant manufacturing economies that may be able to grow their productivity. But if you've got aging populations, then you need to increase your productivity dramatically if you're going to grow the economy, and that may be a problem. The US is perhaps, and the UK with its have better demographics, and Asia in particular, with a large young population, may be much better to have a much better chance of growing out of the debt. On the demographic front, China's one-child policy may eventually slow their growth, but the damage may be some way away, given the relatively undeveloped market still. And China and other Asian countries have been disciplined in accepting the COVID rules, and may be well placed to come out of this looking better than others. And the Asian markets in Korea, Taiwan, China have all done relatively well through this crisis. In the long run, saying something on China, China will be the biggest economy in the world. It was for the past 2,000 years, apart from the last century, and will be once again. It will remain important for us as a source of return, but with markets less transparent, we have to be a little bit careful in how we do it, and the markets tend to be highly leveraged. So on a risk-reward basis, you tend to be more risky there because you get bouts of extreme volatility. And so we look at that as part of our investments, but with a wary eye on it. In conclusion, the pandemic will eventually end. The US will get over the election, and Brexit will be sorted one way or another. After talking about it for the last 4 years, I'm very glad if it's something other. In the short term, they raise uncertainty and make investing very difficult. But the interest rates will remain low or even negative. The Bank of England is talking about negative rates. They're toying with it. I don't think they'll necessarily go there, but we're going to have interest rates close to zero for a prolonged period of time. And those looking for returns will look for companies which can grow their earnings and have a solid balance sheet. There are some companies that will bounce back from this crisis. Some of the things that have been hit hard will bounce back. Others will just go bust. It's not a matter of looking, it's a matter of looking at each individual company on its own merits. So key to returns in this environment going forward will be a selective approach and an ability to look through this short-term noise for long-term gains. It's not going to be an easy ride over the next few months, but trading on a day-to-day news flow will be really bad. Is a really bad idea. We've got to keep our heads and look forward to the better returns. As I say, low interest rates will be here to stay, and that in the end is very supportive for companies that can continue to grow their earnings. Finally, I hope I've answered the questions that people kindly submitted. If you have any questions, then please come back through your investment manager, or you have questions about the impact on your individual portfolios, please talk to them. I publish a weekly brief, if you're not seeing it, which that covers off these topics. I'll be writing again this week, I guess, on the market moves on Friday and on the US election. Seems to be almost perennial in that respect. But for now, many thanks for your time. As I say, if anyone has any questions, come back through your investment managers. Thank you very much.